Hello and welcome to Portfolio Matters, weekly markets checklist, week 140. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Well, we're going to have a packed week this week, but before we get going, some housekeeping items. So this will be the second to last Portfolio Matters of the year. So next week, I'm away hiking in the Lake District. I will get another weekly in before the end of the year, but it will very much depend on schedule, and that will contain just a lot of economic data. Normal service will resume in the new year, in year 4 of Portfolio Matters. News this week. The FT were reporting that there are now 8 million Chinese people who have been blacklisted for defaulting on loans or financial obligations. And that has really severe consequences in China. That's about 1% of the working age population. And blacklisted citizens are essentially locked out of the financial system. So you can't buy plane tickets, make payments on apps, or take part in a lot of other aspects of economic life. So that is not good for the Chinese economy.
Yeah.
And Moody's cut China's credit rating from stable to negative, citing the weakening economy. Now, our front page photo this week is of the Venezuelan president, Nicolas Maduro, who last week ran this referendum on whether they should try and seize the oil-rich Essequibo region of Guyana. And according to his socialist referendum had a 95% yes vote to try to seize Essequibo. And he's now followed through with that by ordering the state-run oil and gas companies to start drilling in Guyanese territory. So he's pushing for war.
He is.
Yeah, absolutely. And reminder, Venezuela has had this rapprochement with the US, and they've said that they will allow free and fair elections. And in return, the US has eased sanctions. Well, if they invade Guyana, then that is surely bad news for Venezuelan oil production and the reimposition of sanctions, and also potentially very bad news for the big US oil companies which are drilling offshore Guyana. Watch this space. That could send the oil price higher.
Yeah.
It should be said that the markets are skeptical that he'll actually do anything. Apparently, he's a big blowhard who talks a fight, but actually backs away from them. Now, yesterday, the yen rallied sharply after comments from the Bank of Japan President Ueda that he may cease yield curve control next year. Now, there are consequences to that. So currently under yield curve control, the Bank of Japan is buying unlimited amounts of JGBs and, in essence, pumping liquidity into the global financial system. If next year they stop doing that, then a big source of global liquidity essentially disappears. So after he made those announcements yesterday, yields on JGBs rose and the yen rallied sharply. But Japanese GDP in Q3 fell at an annualized 2.9%. So the Japanese economy is not doing well. And JGB yields are not necessarily going to rise. A weak economy means weak inflation and low yields. Okay, some charts relating to the news. Well, this is the latest Fed futures curve, and the markets are pricing in cuts, but they're pricing in Fed funds rate bottoming between 3.75 and 4%. So they're very much assuming a soft landing. That would be the highest rate in many, many years and higher than the peak rates pre-COVID. I strongly suspect it's going to come down much further than that. And this is the near-term outlook. Now, you'll notice that there's a difference here when they're saying, Charlie Bilello is saying that Fed funds rate will drop to 3.57% in December 2025. And you'll see the market's currently expecting this smooth decline in the Fed funds rate. Generally, that doesn't happen. Nor the normal outlook for rates is that high rates cause the economy to slow down. At some stage, the Fed cuts hard. But so far, the US economy has not slowed down anywhere near as much as we had been expecting. And the ECB is forecast to be the first central bank to start cutting rates. And actually, the markets are expecting them to start cutting rates in March or in April. The Bank of England is expected to be the last central bank to cut rates and to start cutting in August next year. And the strong rally over the last couple of weeks has taken the Dow Jones to an all-time high. This is a map of Venezuela, Guyana, and the disputed Essequibo region. Now, Guyana actually only has a population of 900,000, and this whole borders dispute, I'm afraid, involves us. So it dates back to 1899, when an international tribunal awarded Essequibo to what was then British Guyana. And the Venezuelans have always disputed that. But essentially, it has been Guyanese territory for 120 years and settled by international arbitration. So if Venezuela were to invade, that would be very much against international law. And this is JGB yields. You'll see they bounced sharply yesterday, but are well below 1%. Let's see what they do next year. They have been loosening yield curve control steadily. You'll see that earlier in the year, in January, the Bank of Japan had a cap on the 10-year of 0.25%. They progressively widened it to 1%. And now that it is not reaching 1%, they're talking about abandoning it altogether next year. And the prospect of the end of yield curve control led to a sharp rally in the yen, which has decisively retreated from the 150 mark. But Japanese GDP growth in Q3 was really awful. Japan is very much in recession. So Q3 GDP growth was annualized was minus 2.9%. That's a proper recession. And on to this week's economic data, the UK, Richard.
Thank you, Keith. So the S&P, UK Global S&P and manufacturing PMI was better than consensus expectations. Still below zero.
Yeah. And if you don't mind, I'm going to read this out. Output continued to decline amidst reports of weakened domestic demand, reduced intake for new export orders, and destocking activities observed among manufacturers and their clients. Moreover, new orders experienced an 8th consecutive month of decline, with new export business dwindling for a 22nd straight month. Employment also sustained a downward trend, along with reduced activity in input buying. Concerning prices, input costs decreased while selling prices rose, reflecting efforts to restore margins. So essentially, that really doesn't sound good. It had a bounce, but I can't see anything positive in there, frankly.
No, it's I think there are significant signs of things, informally signs of things slowing down. Actually, I think we're going to find that the economy is not doing very well for the next few months. So the UK S&P Global Services PMI just peaking above 50. I mean, it's better than expectations, but the numbers we're talking about are marginal.
Yeah. But again, I'm going to read this out, Richard. The latest PMI indicated an expansion in service sector activity for the first time since July, attributed to increasing demand and the completion of unfinished projects. Backlogs of work continue to decrease for the sixth consecutive month, declining at the fastest rate since August. Employment levels rose due to long-term business expansion plans and a tentative improvement in demand conditions. On the pricing front, average cost burdens increased at a slightly faster pace, marking the second lowest rate since March 2021, while the rate of output charge inflation was the strongest since July. So not great, basically. Or in both manufacturing and services, the PMIs are being supported by running through the backlog of work, which is rapidly decreasing. But I also don't like this talk of increasing prices, output prices. That's bad for UK inflation.
Yeah, I think so. I don't think we're out of the woods yet by any means, just as my general sense. I think personally, my view is that everybody's predictions of interest rates dropping down to 2% over the course of the next 18 months will prove to be wrong.
Right. Okay. Well, I think they're going to be right, and I think certainly in the Eurozone, we're going to have very hard deflation. And I think that the UK is a small, open economy. And as the US slows and the EU falls into a recession, I think we're going to follow.
Well, we'll see, Keith.
Yeah.
So the UK, well, the composite, there we are. It's the sum of the two. And it's really very, very marginally up.
Yeah, but bounced back into expansion territory, which are very much against my expectations, frankly.
Yeah. So UK global construction PMI fallen, and I mean, we're hearing bad news in the construction sector, generally speaking. So I expect that will continue to fall for a while, actually. And the housing activity index is declining, particularly the residential activity, actually.
Yeah. And again, I'll read this out. The sector has finally emerged from a period of intense supply chain pressures, and prices are now falling across the board, especially for timber and steel. Projects are no longer being delayed due to unexpectedly high material costs, with November seeing the sharpest reduction in purchasing prices since July 2009. That is great news. That's great news for inflation. But, the activity, not great.
Yeah. UK new car registrations. And the problem with this chart, just look at it, is very short term. Yeah. So basically, you can't. There's no sort of. There's no perspective.
The trouble is, Richard, I tried to put in the 10-year chart, but there's during the pandemic and afterwards.
Yeah.
It goes. It's basically new car sales go to zero, and then they go up by infinite percent. So it just looks very silly.
It's silly, yeah. So we don't. I mean, where were they last November? Question. I don't know actually. I suppose we'll find out. But they are, on the face of it, they are going through a fairly torrid declining period. And CPI distributive trades is on a noisy but significant downward trend.
Yes, good summary.
Retail sales, well, they're not great, but neither are they dreadful.
Yeah, those are nominal, remember, so that's below inflation.
Yeah.
And also November we had Black Friday.
Yeah.
And that failed to lift UK retail sales despite very strong discounting. And in the detail, I was amazed that spending on restaurants has fallen by 11.9% year on year. I mean, that is bad.
It is. I mean, I would say we're not surprised by this, are we, Keith? We've been And as more and more people, there are a lot of fixed rate mortgages still coming off, coming off all the time. More and more people moving into that position of having to spend all their money on mortgage interest. And the discretionary income is disappearing. UK Halifax House Price Index. We've had positive news on house prices. I mean, positive in terms of they've been going up. It depends whether you think house prices in the UK are overpriced or not, and are pricing people out of the market. But nevertheless, the prices have gone up the last couple of months.
I mean, clearly, I think that house prices in the UK are absolutely insane given the high mortgage rates. But then when we had net immigration of 700,000 people last year, Richard, and we built, precisely our 200,000 houses or something, all those people got to live somewhere. So it's not surprising that house prices are failing to fall.
I mean, the whole thing is just the whole thing does not hang together as a coherent thing. It's just nonsense. And of course, look at the pressure it puts on the NHS, the education system, social services, housing, as you say.
Yeah.
It's just total, the whole business is completely shambolic. And is yet another reflection of the gross incompetence of government.
I should also say that Richard's wife works for the NHS, so gets a front row seat of dysfunction.
If I just. And boy, is it dysfunctional. And Jeremy Hunt has to take an awful lot of responsibility for that. He was Health Secretary for 6 years.
Yeah.
And he's moved to become Chancellor, where he's refusing to pay junior doctors a decent rate of pay. I mean, he's one man NHS wrecking ball. Sorry, I'll come off my soapbox now. I just don't understand why they misspelled his name. UK Halifax House Price Index year on year. Well, we saw house prices drop sharply. Now they appear to be ticking back upwards, as we've just discussed.
Yeah.
The mortgage rate is now 8%.
Yeah. Honestly, I don't know who pays the BBA mortgage rate. I mean, I take it this is the standard variable rate.
Yeah.
But, when I've actually looked at the figures, the standard variable rate is not this high for most banks. So anyway.
They compete. That's the top line from which they compete downwards, isn't it?
Yeah.
So there is the summary. So the UK grocery inflation slowed to 9% year on year, as opposed to nearly 10%. I mean, it's extraordinarily high.
But Richard, the price of Christmas dinner only rose 1.3%. So that is a modicum of good news, frankly.
It is, isn't it? Yes.
Yeah. Probably driven by
Brussels sprouts as well.
Yeah.
All the Christmas staples, Keith.
Yeah. Yeah. One day we're going to eat some civilized vegetables as opposed to Brussels sprouts.
I used to like Brussels sprouts when I was a child. I really did. I loved them, and I loathe them now.
Really? Okay. I'm a sucker for punishment.
I was.
Anyway, moving on to the EU after that informative debate. So,
let's be more happy, Keith.
Yeah. Manufacturing PMIs for November slightly beat expectations, but are still just awful at 44.2. I mean, that is the lowest, outside the pandemic and the great financial crisis. Services PMIs bounce slightly, but remain in contraction territory. So the composite bounced slightly, but is still poor and still very much in contraction. The EU economy is not doing well. Construction PMIs were terrible. So it bounced slightly from October, but that 43.4 number is really bad. Producer price inflation came in line with expectations, 0.2% month on month, year on year, minus 9.4%, but bouncing back slightly. We've now had 3 months in a row of positive producer price inflation, but that does not mean inflation in the Eurozone is coming back. That is a reflection of the bounce in energy prices over the period. Now, of course, energy prices are now falling back down hard. The price of intermediate goods has actually been falling steadily throughout the year. That's goods deflation. The price of capital goods appears to have finally peaked, and hopefully that should feed through to declining consumer goods inflation in the coming months. Retail sales in the Eurozone in October ticked up by 0.1% month on month, and they revised up the fall in retail sales in September from minus 0.3% to minus 0.1%. The rise in the October retail sales was still below expectations, and year on year, sales fell by 1.2%. Again, worse than expectations. Surprisingly, consumer inflation expectations were steady at 4% in November, despite inflation in the Eurozone falling rapidly. And that is another reason why the ECB will not be cutting interest rates anytime soon. They're going to want to see that number coming down. And finally, Greece. Now, I thought this was really interesting. So the Greek unemployment rate in November finally ticked down below 10%. Now, if we go back to when the Eurozone was inaugurated in 2000, the unemployment rate in Greece was then about 12.5%. And the first 7 or 8 years of the euro were actually really good for Greece, thanks in part to all their lying and borrowing ridiculous amounts of money. But then the great financial crisis, the imposition of financial responsibility, led to just an amazing depression in Greece. GDP fell by 30%, just amazing numbers. But since then, the medicine appears to be working, and you've had this very steady decline in the unemployment rate. And Greece is now finally back in a better position than when it joined the euro. It's been a long time, but the medicine's worked. And actually, quickly talking about German deindustrialization. So this is the performance of the various sub-industries in Germany, and you can see anything that is energy intensive has got hammered and is showing no signs of recovery. Paper, chemicals, manufacturing, only the electronic sector has done well. And the EU Citigroup Economic Surprise Index, well, it has been coming back towards zero, indicating that the European economy is no longer underperforming expectations. Well, that recovery stalled slightly last week. So in summary, the Eurozone is already in a shallow recession. We expect that recession to deepen in the coming quarters due to the lagged effect of interest rate rises. Richard, the US.
Thanks, Keith. So the US manufacturing PMI still below 50, and not very much changing actually since last month even. And the manufacturing employment index is also below 50, and both of these are worse than expectations. So the economy appears to be declining in a way that wasn't expected by economists. New orders are still below 50. It was quite a little bit up actually from October, and better than expectations. And manufacturing prices paid are increasing.
Yeah, not great, but I suspect that's energy, which has since faded.
Yeah, could well be. And manufacturers are running through their order backlog, so that which is indicative of a future slowdown. So new orders are below 50, employment below 50, prices just about neutral, actually. And backlog of orders is now only 39.3 as opposed to 42.
Yeah. So that suggests to me that this is going to get worse. They're running out of their backlog of orders. New export orders are also declining.
Yes. So the number of industries reporting growth is actually pretty low, isn't it? And there is no sign of any change from there. So that is suggesting that there's not very much to cheer around.
Yeah.
US services PMI still above 50, and services employment is also just about above 50. And services activity looks like it's on a bit of a downtrend, but it's still well above 50.
Yeah.
And services business new orders, again, it's comfortably above 50.
Yeah.
And services prices paid. So services is looking actually quite healthy, and clearly they've still got, after that big drop in prices paid, they seem to have managed to stop the erosion of their pricing power at this point. US construction spending is looking quite healthy.
Amazing. I mean, you look at this, the construction sector is meant to be the most sensitive to changes in interest rates. And this year, every month is kept on growing. And October, 0.6% month on month.
Yep.
Big numbers.
So there's been a general growth in the construction sector, which is really, I mean, there's a few which are a little bit, communications is low, new single family residential units are negative. There's a lot of healthy growth areas. Manufacturing, particularly stands out.
Absolutely. But also religious, Richard. People are, building new churches, getting on their knees and praying for a better economy. Or, in my case, lower bond yields.
Well, all your praying seems to be paying off. So residential construction spending has peaked, and is non-residential spending topping out? ?
Yeah. At some stage, all that investment that was started 2 years ago will come to an end. And we know that the credit impulse is negative. So there will be less new projects being started. At some stage, the non-residential investment will peak.
Yes. So US factory orders month on month, a poor month, has to be said.
Yeah.
And transport, still a poor month.
And it seems that mid-year surge is now over.
And there's more bars below the zero line and above the zero line. So the economic optimism index is still in its noisy decline.
Yeah. Reminder, this is from a survey of US consumers.
And the JOLTS job openings is in a very obvious, quite steep decline.
Yeah. And that missed expectations by a margin.
Yeah. And the job quits is following basically the same trajectory. So people are feeling less secure in their jobs. So the jobs market is tight, but it is weakening fast. The ratio of openings to unemployed workers has dropped to 1.2 from 1.8. The private sector hire rate is roughly at its long-term average. So there's nothing unusual there. The question is, will it fall below it? And layoffs are low. So no signs of sort of pain being felt.
Yeah. So the general picture we're getting in the US is that companies are hoarding labor. So they're not laying people off, but they're now slowing down their hiring rate.
Yeah. And the ADP employment change, it's not looking particularly strong, but it's still looking quite healthy. The challenge of job cuts is looking, it's picking up a little bit, but it's not looking particularly out of kilter. In fact, it's better than it was in the start of the year. Productivity growth has been very, very healthy. Certainly we could say the same for the UK.
Yeah.
and productivity growth in the US is back in line with trend. If you remember the UK graph, we have the trend dotted line, and about 5 years ago, our productivity basically flatlined, didn't it? And the gap between the dotted line and our productivity is widening.
Yeah, the UK productivity has basically collapsed after the great financial crisis. And I really wonder whether that is increased regulation in the city.
I completely agree. So we've recently, unfortunately, had to do a probate. And the degree of pointless checking and the circularity of the process of contacting everybody is extraordinary. And you just think the whole economy is gummed up in excessive, useless regulation.
Yeah. So, frankly, I think we should just loosen regulations on banks and hedge funds, but, not backstop them. If they're going to, just say that you can have an investment bank and it can do the hell what it likes. But, if it goes bust, we're not guaranteeing it.
Yeah, exactly. US non-farm unit labour costs annualized are falling. And as Keith pointed out, this is the flip side of the productivity increase.
Yeah, this is what a healthy economy does. Productivity grows and offsets the rise in wages. Not the UK.
No, not the UK. What are we? Lions led by sheep. The fall in unit labour costs is also obviously good news for inflation.
Yeah, and shows it's highly correlated, actually. This chart shows it's highly correlated with PCE inflation, core PCE inflation.
Yeah, it is. Yeah. US total vehicle sales looking quite healthy, really.
Yeah.
Unlike the UK. The US Logistics Managers Index is not looking that great.
Yeah, that bounce, which we were puzzled by, is now unwinding.
Yeah. Redbook retail sales, a sharp spike, a sharp drop, but still at 4%, 3.5%, 3%.
Yeah, the thing is, last week it was Black Friday. It seems like, just had this spike due to Black Friday, and now it's unwinding again.
US MBA 30-year mortgage rate just fallen back down from its nearly 8% high, easing the pressure on the property market, and the mortgage market index is actually slightly better than it has been, but still on the floor.
Yeah, still dead.
Yes. US initial jobless claims. If someone said to you, look at this chart and tell me what the US economy is doing, you'd say, well, it seems to be doing fine, mate.
Yeah, completely agree.
And continuing jobless claims, well, it's looking a little bit less than fine, but it's not looking dreadful either.
Yeah, now we talked about this last week, but the peak last week and elevated levels are due to the seasonal adjustment. If you get rid of the seasonal adjustment, actually year on year, it's doing nothing at all. In fact, it's declining. So really, there is no sign that the US unemployment rate is picking up. Here we go.
There we are. There isn't. Job postings on Indeed showing a seasonal decline. US New York Fed weekly economic GDP estimate 2%.
Yeah, it's drifted off though slightly, 2.1% this week. Still healthy, but
And the economic surprise index is basically not surprising at all, is it? It's just drifting along.
Well, it's coming down. So previously, the US economy was outperforming expectations. I know you hate this chart, Richard, but I persist.
It's very noisy, isn't it? It'll go back up next week or something. The Atlanta Fed GDP now. That actually has dropped significantly, hasn't it, over the last week?
It has. Now, I wonder about this, though, because we're now, midway through December. So we are, 3/4 of the way through the quarter. Anything that's happening in the economy right now will not make that much difference to Q4 GDP growth, I would have thought. And so
its question is it's more perhaps its predictive capacity as to whether the US is entering a recession, but actually, everything else is saying it's not yet.
Yeah,
so,
absolutely.
And there is the summary. Read the bullet points yourselves, but the US economy is remaining resilient due to the services construction sectors. There are signs that it may be slowing, as we've been saying for about a year now.
You're right.
And we still do expect the slowdown to get worse in the coming months.
Yeah.
And it should be a portfolio matters economic surprise index, shouldn't there?
Yes, I know.
This is surprising.
Yeah.
Oh, that's surprising.
Yeah. I'm just praying for that index to one day go negative. Anyway, on to China. So last week I reported the NBS, which is the National Bureau of Statistics PMIs, and they were all worse than expected, and they portrayed a Chinese economy where the economic recovery was faltering. Now this week we had the Caixin, which is the private sector PMIs, and they showed precisely the opposite. So this is manufacturing, strong bounce in November, back into expansion territory. Services PMI strengthened more than expected and is now still in expansion. And as a result, the composite bounced to 51.6 in expansion, and the recovery is strengthening. We look at the balance of trade, that improved and was better than expected, thanks to an improvement in exports and a fall in imports, and that was much worse than expected. So the PMIs are just very difficult to interpret because the official ones are saying that the economy is getting worse, and the private sector ones say it's weakening. Who knows? But if we look at the hard data, exports beat expectations, which means possibly the global economy is doing better, while imports missed expectations, which suggests the Chinese economy is actually doing worse. And as we go through, when we show you the Hang Seng index of Chinese equities, that is having a terrible year, which is getting worse. And that suggests that on the ground, the Chinese economy does not look so hot. And onto one chart. So every month we report the University of Michigan survey of consumer sentiment. And one of the puzzles we have had this year is that actually the US economy has been fine. It's been stronger than expected. So how come the consumer sentiment survey is absolutely awful? Earlier in the year, it hit an all-time low. And even now, it's at the bottom of its range, towards the lows of the great financial crisis. Well, it's because US consumers feel pretty awful. So this is the growth in real incomes in the US. And you can see that they've actually fallen over the last couple of years at an annualized rate of about 2.5%, which is just about the worst it's been outside the GFC. So the reason that US consumers feel so pessimistic is that they have experienced a recession-like fall in income without there actually being a recession.
So inflation watch. So we have no new data on this table at the moment. We've got meetings of the FOMC on 12th, 13th December, Bank of England and ECB, both the 14th of December, which will be watched very closely. And the food price index is continuing to come down. Obviously, it spiked up really sharply, and it's dropped back down pretty sharply as well. I have read that is it shortage of rice, I think, isn't there? There's likely to be a shortage of rice.
Really?
at
Mm,
some point. I mean, I think these big agricultural staples, they go through their own cycle, don't they? And there seems to be a shortage of one or the other most of the time, but then
mm.
they also substitute for one another.
Yeah. When we come back in the new year, I will have a look at all the agricultural commodities. We do that, occasionally
Yeah,
over
that would be
a few months.
interesting.
Mm.
I think orange juice has gone up by factor of fourfold, hasn't it? But that's
Yeah.
big, something to do with California.
Well, that's Florida, and they're
Florida.
suffering from drought, but also this disease of the citrus trees. But I noticed that the price of orange juice in the supermarket has not gone up fourfold. So presumably they're sourcing European orange juice from somewhere else.
Spain, maybe. So month-on-month change in national rent index is actually 1.1% year on year.
Sorry, minus
Yes.
1.1%, mate.
Yes, sorry, the fall, I do beg your pardon. So the fall 1.1%, which is quite a significantly large drop in the national rent index in the US. Clearly will impact the rate of inflation. The apartment vacancy rate is gently rising, which means there's a little bit of pressure on rental prices. And there's a glut of new apartments coming into the market in the coming months, which may further cause rents to fall again, which is good for reducing inflation. So US M2 money supply has fallen incredibly fast. Has it stopped falling is the question, really. I think, isn't it, Keith? Now, so it's moving up a little bit from from its low point.
But when you look at this chart, Richard, you think the monetarists have been right over the last couple of years. In that, do you remember when we first started this podcast and everyone was saying, the banks were saying, and the central banks were saying that inflation was going to be transitory and they didn't have to raise interest rates. And, they were ignoring the fact the money supply had shot up by 27%, and now we've had a reduction in the money supply and inflation's come back down very quickly.
Yeah. I guess the question is, can the reduction in money supply hold? That's the question really of whether the Fed has to re-engage QE.
Well, I think the fall in the money supply is due to the fact that you've raised interest rates so much, which has reduced the loan demand, etc., and the velocity of money. And so, as long as you keep interest rates high, you would tend to see that number drift towards zero, and loan growth, money supply growth being flat on the year. When they start loosening interest rates, I think it goes back positive.
And basically, the money supply should grow at the same rate as the economy, shouldn't it?
Yeah.
So, and which sort of, if you look at the long-term trend, which is around about 5%, I'm guessing here, just interpolating that, the money supply is probably has been growing at slightly faster than the rate of growth of the economy. Certainly more recently, although no, 5%.
Yeah, well, that's because we've got inflation, mate. You're right. It should grow at the same rate as the economy, but it's been growing faster, hence inflation.
And US gasoline prices, that's a really weird looking graph, isn't it? I mean, they've sort of round tripped all the way up over the last 12 months.
Isn't it? But it's great news for inflation.
Yeah. US used car prices are continuing to fall back down to what would have been more like a long-term average. Although not there yet by any means.
I know, there's still a third higher. That's big for used cars.
And the EU 3-month annualized inflation is rapidly approaching the 2% target, services and core.
Yeah.
Well, core is actually negative now. So it looks like inflation is licked, Keith.
Well, in the Eurozone, honestly, I think it is. I think the Eurozone is in recession. And, you've got a negative money supply growth in the Eurozone and a big negative credit impulse. The Eurozone economy is likely to continue getting worse over the coming months. And I think they're in for a disinflationary bust, basically, as shown on this chart.
Yeah, interesting. Which is where we are now. So the EU money supply has also fallen in red, has also fallen very sharply. So the composite PMI would be possibly expected to follow it down.
Yeah,
There is a sort of correlation there.
yeah. This goes into the slightly dodgy chart folder, frankly, but there may be a correlation there. But you'd expect falling money supply to be bad for the economy and very good for inflation.
And the euro area job market is not tight, so there's plenty of vacancies.
Yeah, the trouble with this is that as we've discussed many times, the eurozone is not an ideal economic or monetary zone. In that there are loads of Greek people or Italians without jobs in the south, and the vacancies are, let's say, in Finland, or Denmark, and you can't move between the two. It's not like the US, so hence it's much less efficient economy.
Yeah, there are supply problems in the UK market, same graph basically, but obviously labour supply is at labour demand.
So they're now saying there's some slack in the economy, in the labour market. I'm not sure I believe this, frankly. All the data we're seeing is that in the UK, the labour market is still tight, and there are more job vacancies than there were pre-pandemic. So but then again, we have had huge immigration over the last year. So,
Yeah, one of the things that slightly concerns me about these graphs is they're always presented as being definitive, but we know actually the data is pretty hard to come by and pretty hard to get accurate data for these things. So
yeah, very true. And particularly true for the UK, frankly.
Yes, as we know. So in summary, inflation everywhere is coming down, and it seems likely it's going to continue to fall for reasons we discussed. The Eurozone inflation is closest to the 2% target, and the ECB is felt to be likely to be the first central bank to start cutting rates. And indeed, some market commentators are suggesting it will be in the first quarter of 2024. We will see.
Thank you, Richard. And now we have a long segment about global oil production. Now, we know that the oil price has been falling sharply in recent weeks, which suggests the market is concerned about market balance and supply exceeding demand as the global economy slows down. So first of all, let's have a look at OPEC, and we have data there to October. Now, all this data comes from the Peak Oil Barrel website, and this is production for the OPEC 13, and you can see that it is well down from its peak in 2017, and more importantly, over the last year, 18 months, there's been a sharp drop in OPEC oil production, which is led by Saudi Arabia. And this gives a breakdown of OPEC production in the last couple of years, and we have production for October. And you'll see if you compare October production with 2022, it is down by about 960,000 barrels a day. A lot. Of that, Saudi Arabia has contributed 1.5 million barrels. So Saudi Arabia has contributed more than 100% of total OPEC cuts. Saudi has cut. Other countries have been increasing their production, and the main two are Iran and Nigeria and Iraq. And these are the cuts agreed at the last OPEC meeting this month. So Saudi were going to roll over their 1 million barrel a day cut. Russia committing to 500,000 barrels a day. And with lesser contributions from other countries, you'll notice that Iran and Nigeria are not contributing anything at all. Okay, so let's go through the countries, see who's complying, who's not. Well, Algeria does seem to be complying with the cuts. Angola, its production has been rising, and Angola is a big producer. It's about 1.2 million barrels a day, not cutting at all. And actually, I believe it threatened to not appear at the OPEC Plus meeting because it did not want to cut. Congo, not cutting, but that's a small producer. Equatorial Guinea, not cutting, tiny. Gabon, production is rising. Iran is the problem for OPEC. So while Saudi's been cutting, Iran has been taking advantage of the higher oil prices to increase its production. Iraq, well, is it or is it not delivering on its promise of 223,000 barrels a day cut, in that it's a cut from what? If their production capacity has been increasing, then I don't know the exact mechanism of how they're measuring the cuts, but certainly their production has been growing over the last 6 months. Kuwait, complying with the cuts. Libya, its production is stable. It is not committed to any cuts, but its production is not growing. Nigeria, its production has been growing quite sharply, actually, over the last couple of years, from a low of 1 million barrels a day in 2022 to 1.4 million barrels a day now. Saudi Arabia is the only OPEC country that has really committed large cuts, and its production is down 2 million barrels a day since its peak in mid-2022. These cuts are costing Saudi Arabia a lot of money. How long will it persist when it appears to be simply giving away market share to other OPEC members, such as Iran, which are taking advantage of the higher prices Saudi Arabia is creating in order to increase their own production? The UAE is delivering on its cuts, but you see how small those cuts are compared to Saudi. Venezuela recovered a bit, but not much given its sanctions relief from the US. And frankly, if it's going to start invading Guyana, I expect sanctions to come back on pronto. So OPEC summary: Saudi Arabia has cut 2 million barrels from its recent peak in mid-2022, but other OPEC members have not agreed to join the cuts and have actually grown production strongly over the last year. Nigeria and Iran in particular. Iraq has been growing its production over the last 6 months. Is it complying or not complying with its commitments? Not sure. So, and also Russia, we just don't know. We don't know. It's very Russian, because of these sanctions and Russia exporting through lots of illegal and unofficial channels, it's very difficult to track whether Russia is actually complying with its cuts. We suspect not. So Saudi Arabia seems to be single-handedly holding up the whole oil market. How long will its patience last? Reminder, the last time there was a big oil downturn, Saudi eventually got fed up. If we go back to the Saudi chart, it got fed up with cutting. This is during the pandemic, and opened the taps. And because other OPEC members were not contributing to the cuts, and that got their attention. The oil price completely collapsed, and suddenly all the OPEC members came on board with cuts. This time, you could see a similar thing happening if the oil price continues to drift off. Okay, and now let's turn to non-OPEC. And we only have data to round about July, but you'll see the data for different countries is to different dates, so be aware. So this is non-OPEC total production forecast out to 2025. July, we've had actually decent growth this year, and non-OPEC production is forecast to grow by another 1.1 million barrels a day in 2024. Now, going through countries individually, this is Brazil, and you've had very strong growth over the last few years from Brazil, and that is expected to now slow, and not much more growth is expected in the next couple of years. Chinese production, well, from its lows in 2018, it's actually recovered decently well. And there is this kind of upward slope to that chart affected by strong seasonality. Kazakh production going nowhere. Mexican production actually has bottomed, and that seems to be back on an upwards path as the Mexican government has loosened the restrictions on Pemex. Norwegian production stable, and I think you'd say that there's a slight upwards drift. Omani production down from its peak, but actually that's quite a lot per day. Qatari production very disciplined. Russian production, who knows? Are they or are they not complying with their cuts? Depending on who you ask, you get completely different results. The US is the big swing producer. So from its lows in the pandemic, US production has grown very sharply, and it is forecast to continue growing in 2024. So despite the OPEC plus cuts, world oil production is forecast to rise in 2024. Hence, it's going to be difficult for OPEC plus to keep the oil price high if the world economy slows as we expect it to. In 2024, oil production will rise and demand is likely to be weak. Hence, in order to just maintain the current oil price, Saudi would have to organize further cuts. And we know that OPEC Plus has always had difficulty enforcing discipline, and only a small subset of the OPEC Plus producers have actually committed to these cuts. The danger is that Saudi gets fed up with this situation and decides to open the taps and allow the oil price to collapse. At that point, Saudi gets OPEC's attention and better compliance with future cuts. And that's what they did last time. But the road to higher oil prices therefore leads through much lower oil prices. And so I would be wary of buying oil or oil companies at this point. And while we're talking about oil, let's go through US shale as per the EIA's latest drilling productivity report. So we're going to go through each shale region. So this is Anadarko, and you can see that its production peaked in 2019, and it's been on a bit of a downward drift ever since, but fairly stable. Now, new well productivity has been rising, and it has been rising, you'll see, for almost all the shale regions. So we know that the shale revolution is a technology revolution, and what's been happening is that although the main areas of the smaller shale regions such as Anadarko are now drilled out, and they're now moving into less productive regions of the shale plays. New well production has been improving because they are extending the length of the laterals, and they are using more proppant to keep the cracks open. So if you look at productivity per 1,000 feet of lateral, that has been declining, but per well it's been growing because each well is now drilling further. Moving on to the Bakken, that again peaked in 2020, but production has stabilized and oil production per well has been improving. In the Eagle Ford, very similar pattern, and again, production per rig, I should say, improving. So each rig is drilling further. Niobra production, actually having peaked in 2019, is growing very slowly again. But there, new production per rig has recovered a bit, but that is not on a strong upward path. Finally, onto the big region, which is the Permian. The Permian is the only one with significant spare capacity to keep growing. So production was 6 million barrels a day in November. Productivity per rig is growing sharply. And if we look at the Permian, then it gives a very good illustration of what I've been talking about. So if you look at the productivity per lateral length of 10,000 feet of lateral drilled, you'll see actually productivity peaked back in 2016. Although back during the pandemic, they high graded and so drilled out the remaining most productive areas. But you'll see that despite using more proppant, they've struggling to maintain the productivity per lateral length. But we've seen per well, productivity has been recovering because the lateral length of each well just keeps on growing. So back in 2012, in the Delaware Basin, the length of lateral was around 4,000 feet. Now it's 9,000 feet. So the length of the wells has more than doubled. And the amount of proppant they're using has gone up, is that tenfold? So reminder, the way fracking works is you use hydraulic pressure to create lots of cracks in the rock through which oil and gas can escape. And to keep those cracks open, you pump in proppant, which is sand or small ceramic beads. And what they've discovered over the years is you need much more proppant to keep those cracks open. And so productivity per well is being improved or by drilling longer and using more proppant to keep those cracks open. So in summary, when we look at US shale, only the Permian Basin has yet to hit its peak production, and it's the only one still to have growth potential. Production there is forecast to grow steadily until 2028 and peak in the 7.3 to 8 million barrel a day range. So the US, the marginal producer, still has spare capacity for a good few years yet. And OPEC, if they want to control this oil market, what they're doing is counterproductive in that by keeping the oil price high, they are encouraging the shale drillers to keep on drilling. So if OPEC wants to impose greater discipline, then the path to higher prices could well lead through lower prices short term, in that they need a lower oil price would cause some difficulties for the shale drillers and for them to cut back.
Well, thank you very much for that, Keith. It's really interesting. And your comment about being wary of investing in the oil market or oil sector, very interesting too. So, recession watch. Heavy truck sales have finally, post-COVID, started to fall. And is this a harbinger of recession? Question mark. I mean, clearly it's another indicator that may be indicating the US economy is slowing down.
Yeah, if you look at it historically, there does seem to be a decent correlation between sharp falls in heavy truck sales and recession, although there are quite a few false signals, such as the one in 2015.
Yeah. It's also quite a leading indicator, isn't it? If you sort of draw, if you take 2000, for example, draw a line down from the peak, it's probably 1998.
Yeah, you're right. Yeah. So that would indicate actually recession in the US may be still quite a few months off.
Yeah. And you heard it first here. Hotel occupancy, which bounced hugely, obviously after COVID, is falling now 1.4% down year on year. The average daily rate up much less than inflation, actually, only 0.9% year on year. So it's the decline in hotel occupancy, an indication that the US economy is slowing down with a reduction in discretionary expenditure.
It's interesting that it's never attained its 2018 level again.
No, I wonder if that's because commercial traveling is much reduced.
Very good point, Richard. That must be it. Yeah.
Because we're all doing it by Zoom. Bankruptcy filings are continuing to rise. And that line is where, actually, it's the highest it's been since the 2008 recession. But have they peaked? Because it looks as if they have. They may have. I'm not quite sure what the difference is between these two data series, Keith.
No, I don't. This is clearly a cumulative sum of some kind, but
yeah,
this to me looks. This has got more data in it, so we can see, the weekly bankruptcy filings.
Yeah,
and we don't know how the previous one was created. This one seems more reliable to me, and that's showing that bankruptcy filings may have peaked.
There we are. More equivocal data from Portfolio Matters.
Yeah.
Which I mean, there is a lot of equivocal data out there, isn't there? That's the difficulty. So the Brave Butters Kelly index even, it is a coincident and a leading index, and it summarizes 490 macroeconomic time series back to 1960. It generates a coincident index that provides a snapshot of the current state of the economy, a leading index that looks towards the future, and monthly GDP growth estimates. So basically, if you look at 2010, the leading index fell below the -1 line. And but what we could see here, I'm ignoring COVID, by the way, what we could see here is that neither of these are below the -1 line. And the leading index falling below -1 in June 2021 was obviously a false indication, wasn't it?
Yeah.
So this is October. This is a chart that shows retail sales, and student loan payments, if you recall, resumed in late September, early October, I forget which, and retail sales plummeted thereafter. So question, has that absorbed a lot of disposable income? Answer, quite possibly. And global commercial property deal volumes have collapsed, completely collapsed everywhere. And that's really quite startling, isn't it, Keith?
Yeah.
And the question is, potentially a lot of unrealized losses sitting on the balance sheets, or not actually sitting on the balance sheets, but that ought to be on the balance sheets of the existing owners, query the banks and investors. So, and I noticed a lot of property funds have gated, haven't they?
Yeah. Yeah. So a lot of financial institutions that loaned money to property developers presumably are also sitting on big unrealized losses.
Yeah.
But so far, the market seemed very relaxed about the possibility of losses for financial institutions and a wider systemic problem. So just have to wait and see.
And the credit impulse, which is quite a reliable indicator of recession when it turns negative, well, very reliable actually. The credit impulse has turned negative, significantly negative, minus 5%. And private demand year on year, this is in the Eurozone, by the way, private demand year on year, as we also know, is falling quite quickly. So that is quite suggestive that the Eurozone is entering a recession. So the US economy may finally be slowing. There are more and more indicators suggesting there is a slowing, although there are some that are still suggesting it's firing on all cylinders, such as the 5% GDP growth. The slowdown in the Eurozone is likely to deepen in 2024. And I also think that the slowdown in Germany is really quite nasty and very difficult to correct because it's based on energy prices, which the Eurozone has very little control over.
Yeah. And one of the things I've learned this year, Richard, is that there is this huge lag between monetary policy and the effect of monetary policy. And side effect of that is, in order to slow the economy, you need to raise interest rates incredibly quickly. Well, I think it works on the other way around as well. So if you want to get a response out of the German economy, you're going to have to cut interest rates really hard. Now, we don't know the timing of that, but I think at some stage the ECB cuts rates further than the market is expecting. Now, whether they start cutting the end of the first quarter, I really don't know. But when as you say, when you look at the German economy looks really bad.
It oscillates around the mean, doesn't it? The response of the central bank are late in both directions, and thereby have to be exaggerated. Okay, so we're going to have a quick look at the price of new houses in the US. The median sales price of newly constructed homes in the US has actually fallen quite significantly, by nearly 20% in the last 12 months or so. Why is that, is the question. There is a shortage of existing homes for sale, but there are plenty of new homes for sale, with almost 8 months of inventory of new homes, which is significantly above the long-term average, as you can see. And this is a chart that shows the housing supply versus home price growth 6 months ahead. And what this shows is that a high inventory, which we currently have, equals low future prices. So on the bottom, we've got months supply of new houses, and on the top, we've got house. On the left, we have house price growth. So we're somewhere down on the bottom right in terms of months supply of new housing. So are we going to see further falls in new house prices?
Yeah, and if you go back to this previous chart, Richard, you'll see that the because of the collapse in transactions for existing homes, that the inventory levels for existing homes, they're low, but they're rising, and actually the same is true. So the months of supply for existing homes is turning back up again as well, suggesting further falls ahead.
Yeah. So existing homes are selling at an 11.5% premium to new homes, which is the wrong way around. Normally, new homes sell at a premium. Well, in the UK, new homes tend to sell at a premium to existing homes.
Yeah.
So this seems to be a little bit backwards. I assume the same is true in the US. So the market's got itself a little bit upside down. So the question, house builders have got too much inventory. And we've seen this as we've been looking at it over the last few months, where continuing permits and building rates and employment in the sector have not fallen back. So there's too much inventory. But if that is true, why are housing starts still so high? And are they still so high, Keith? Is there any sign that you've seen that they're falling off?
Well, they're down from their peak, Richard. But we cover this. When we each month we look at the data, they're still at a decent level. They haven't collapsed.
Yeah.
You'd expect, if you're having to cut your prices by 20% to shift inventory, and that your costs have risen sharply with labor costs over the last couple of years, then your margins must surely have collapsed. But they're still producing now. Actually, I had my usual weekly call with the US fund manager, and he was saying that the US house builders can keep on producing these houses currently because they bought the land cheaper back in the bottom of the pandemic, etc. But going forward, they're likely to slow because they're going to run out of the existing land bank, and then they're going to have to buy new land, and that's expensive. So he is suggesting that at some stage housing starts are going to have to slow, but currently we're seeing no indication that that's actually happening.
I mean, the general point really is that the US housing market is not behaving as you would expect it to behave with the increase in interest rates, apart from existing home sales, which you would have expected to fall back. The people aren't prepared to reduce the asking price there.
Yeah. And on that front, let's have a quick look at the US housing market. So if we look at the market as a whole, the median sale price is actually up 4.2% year on year, despite the rise in mortgage rates. And as Richard has just covered, a fall in the price of new homes. And year on year, housing payments, so that's the median mortgage on the median asking price, is up 13% year on year. Pending sales down 7% year on year. New listings actually growing. So actual sales falling, listings growing. So there's a rise in the inventory levels, as shown here. And 27% of homes now sold below the list price. 5.7% had price drops. These are not big numbers, to be honest. And the average home sold for 98.8% of final list price. That's not a big discount, frankly. And discounts were bigger last year. And if you look at the demand index, so that is the index of home buyer requests for home tours, then it's down 5% year on year. I mean, demand is just not collapsing in a way that you would expect, given the big rise in mortgage payments and the rise in house prices, leading to a total collapse in affordability. Pause and read this. There's this channel, Triple Net Investor, that covers US property, and some of the stuff on there is really interesting. So this is a new high-rise apartment complex in Chicago that has been sold for $59 million. Now, it was sold by the developer, and the developer took out a $69 million loan in 2020 to make it. Plus, they would have had to put their own equity in. So why on earth is anyone building new apartment blocks in the US when they're worth much more less than their construction costs? That surely has to be bad for the construction market. And when in my call with my US fund manager, he was actually talking about a friend of his who had 10 rental properties. And his friend, he outsources the management to a management company, and the management company had advised him that he needs to cut the rent by 20% on 2 of them because rents have fallen. In order to stay competitive, he needs to reduce the prices. But also, the bank has told him that he needs to sell one because he's over leveraged. And you suspect that similar calls may be coming through to other rental landlords in the US, and that will lead to a rise in inventory for sales. And that is picking up in Florida, where we know there's been a lot of speculation. So house prices have been growing and holding up incredibly well. But if banks are phoning round telling landlords to start cutting their portfolio, then surely at some stage that's going to lead to falling prices.
Yeah.
And just to reiterate, house prices have been rising. Affordability is pretty much an all-time low. Pending home sales are pretty much the lowest ever.
I was just going to say, Keith, in the US, and I suspect elsewhere, we have two property accidents waiting to happen: the commercial real estate and the residential real estate.
Yeah. And, why is anyone buying a house when it's so much easier to rent? And, all these new apartment blocks are coming on, rents are falling. That metric is only going to get wider unless interest rates fall. So basically, this is just incredibly bad news for young people. So affordability of new homes is terrible, and it's very difficult to get onto a property ladder.
Yeah.
But right now, the US housing market, house prices are growing, and the market is mystifyingly strong. We expect it to start showing some signs of weakness in the months ahead. Okay, and on to other charts, Richard.
Thanks, Keith. Wow, short sellers see an $80 billion hit as the November rally in shares upended their bets. That's quite a big loss, isn't it?
Yeah. And the strength of the equity market over the last month has been absolutely amazing. We'll go through the numbers in due course.
And we are all more solitary than we were pre-pandemic. Home working is a contributory factor. And Americans spend a great deal more time alone, less time with friends, and less time with companions, which is rather sad.
Yeah. And actually, that is going to be terrible for people's mental health, I would have thought.
One of the issues I'm sincerely hoping that the COVID inquiry is going to actually get onto once it's finished all the political mudslinging that is entertaining but is not seminal to the debate, in my view, is what was the damage that was caused by the lockdowns and by the scientific advice on managing the pandemic?
Yeah. I hope they'll get onto that. I'm not expecting they will, Richard, frankly, because so far, everything I've seen is like we should have locked down earlier. And, the tone seems to be that, the government could have stopped all deaths if they'd managed it more carefully. I just don't think that's true. And I personally do not think we should have had the second or third lockdowns.
I completely agree. And of course, look at the educational attainment that we haven't got now, the problems we've got with educational attainment.
Yeah. But they're not voters, Richard. Nobody cares about them. Triple lock.
So the Americans are getting more lonely, more sad, more dissociated from their fellows, and are shooting more of them in mass killings than ever before.
Yeah. So actually, I thought this was amazing. In 1990, there were 33% of Americans said they got 10 or more close friends. Now, you look at it, 12% of the US population say they've got no friends at all. God, that's bad.
It is, isn't it? Yeah. It is actually a societal breakdown. It's a fundamental problem with society when it's moving in this direction, because it means individuals are becoming more insular, and the society is dependent upon individuals interacting with each other.
Yeah, absolutely. Question for you. How much do you think social media is to blame for this?
Yeah, it has to have some responsibility, doesn't it? It can be a scapegoat. What I believe has happened, what I think fundamentally has gone wrong with our political system is that our politicians have put being re-elected above every other consideration. So effectively, our politicians have corrupted the democratic process by putting their re-election at the top of their agenda as opposed to governing well.
I agree with you.
Shall we go and have a drink, Keith?
We do enough of that, Richard. That's not drinking enough is not our problem.
Yeah, across the border, I suspect.
Yeah. War in Ukraine starts. Suddenly, German exports to Kyrgyzstan. What's that? Heptupel.
Yeah.
Hmm.
War in Ukraine will stop soon.
Yeah.
Chinese property sales failing to recover.
Yeah.
2023 flatlining.
Those are big drops, though. God, that's big.
Yeah, aren't they? Yeah.
Okay, and on to good news. Well, this is an electric boat. Are you going to be converting your mega yacht to electric, Richard? See, the combination I would have thought between lithium ion battery and seawater is bound to be a good one. And while we're on this track, the car park at Luton Airport burnt down.
Oh, yeah.
And the official line is that it was a fire in a diesel car. Yeah.
Oh, yeah.
Like that happens all the time. Yeah. So
my question, Keith, is was this car park built out of wood?
No, it was built out of steel, actually. It was a horrid steel structure. So, but the story I've heard is that, the official line is it was a diesel car that caught fire. But, that never happens.
We all know that diesel is highly inflammatory.
Yeah.
If you drop a match in diesel, it goes out. Diesel is not, it's like dropping a match in cooking oil.
Wow. I didn't know that, actually.
Yeah, give it a go in your back gardens. It does, because it's not terribly flammable. It needs to be compressed and vaporized, or not vaporized, atomized to make it flammable.
Can I try it in my neighbour's back garden? Anyway.
I can see the headlines in the local newspaper.
Yeah, exactly. Now they want us to trim our oak tree. We're not keen. Anyway.
I wanted to see whether it was true what they said about the Luton car park fire. Yes. He said.
Yeah. Well, all this leads up to the fact that I think everyone knows it was an electric car.
Electric vehicle.
Electric vehicle that went up. But anyway, the Swedes have developed a electric hydrofoil capable of carrying 30 passengers. Top speed of 35 miles an hour. God, that's fast.
Yeah. And it's very efficient, isn't it? 80% less energy. A lot of that, of course, is because of the modern design of the hydrofoils.
Yeah. So there you go.
Very safe. Pretty as well, isn't it?
There's
no way you'd say that was an ugly looking vessel.
Yeah. No. Perfectly safe as long as the lithium ion battery doesn't catch fire. And then it's a large cooker capable of incinerating 30 people. Anyway, moving swiftly on. Equities, Richard.
Thank you, Keith. So the FTSE World Index, as we have alluded to, is doing very, very well at the moment. Stock markets all around the world are doing very well, just as we predicted on Portfolio Matters, or actually...
or not.
Or not, yes. The FTSE All Share is up 0.2% for the week. FTSE All Share really actually is one of the few stock markets that's not doing very well this year.
Yeah.
And it's relatively poorly. It's only up 0.5% year to date. The Euro stocks had a very good month and up 10% for the year, 1% for the week. And I think the DAX hit an all-time high, didn't it?
I'm just absolutely flabbergasted. German economy it's the sick man of Europe. Interest rates have risen sharply. Why on earth is the DAX up and the US stocks up? Mystified.
So all I can think is that people are buying shares on the basis that they will go up when interest rates are reduced and QE restarts. That's the only logic that makes sense to me. The S&P 500 up nearly 20% year to date, up 0.4% on the week. And NASDAQ Composite 37 year to date, 0.8% on the week. And the Russell 2000, even the poor little Russell 2000, which has been such a laggard, is up 3.3% on the week, and now 6% year to date. And the question there is, is the Russell 2000 going to start catching up with the Magnificent Seven, as they're now called?
No, is the answer.
The Hang Seng, however, being tightly linked to the Chinese economy, is doing badly, down 3% on the week, down 17.5% on the year. And I think a lot of this is tied in with the Chinese property problem, isn't it?
Well,
bonds.
Every week when we talk about China, we talk about how difficult it is to get, good data on China. Well, Hang Seng, is that a decent proxy? It says the Chinese economy is not doing very well, frankly.
It does, doesn't it? Yeah. And the topics up nearly 23% year to date, down 2.5% on the week, but it's had a good run for its money.
Yeah, and that's just because the yen strengthened, frankly. So kind of inverse the yen.
Bitcoin up 160% year to date and 13% on the week. There we are.
Yeah.
Doing well. And the pound it's pretty much unchanged. Well, it's actually 4% up on the year. A little bit of a change on the week. So the dollar index is falling back a bit, isn't it, at the moment?
Yeah. So the dollar index is strengthening, what it means, Richard. It's the inverse.
Sorry, I meant dollar index has fallen back over the last couple of months.
Oh, right. Okay. Yeah.
And there's the euro, as Keith says, the dollar index is currently strengthening right as we speak. The euro unchanged on the year, small change on the week.
Yeah. For some reason, the usual Google Finance chart was not working today, so I've had to use Yahoo.
There we have the dollar index, which is strengthening now, has been weakened during November. So, but it's also bouncing around, isn't it? Nothing is really moving very much at the moment.
Yeah.
In the dollar index, euro and pound.
Yeah, there's a kind of seems to be, this cycle to the dollar index.
Yeah, exactly. I wonder whether it's being limited by central banks. So we have the VIX, which is still very, very low, down 40% year to date. And obviously, it's sort of the negatively correlated with the US stock market.
Yeah, just absolutely amazing. Volatility is dead.
And the fear greed index is nicely in greed. So there's a dwindling band of financially strong companies. So in 1987, 60% or so were considered to be financially strong. Now we're down to 10%, which means that if this is correct, the formula takes into account profitability, leverage, liquidity, solvency, and activity ratios. These are all sort of things that are fairly fundamental to a healthy business, particularly in an environment where interest rates are higher and have risen or are rising. And this is just shows an extraordinary degree of vulnerability of companies to economic tribulations. Dangerous, I would say.
Well, I think it shows the effect of very low interest rates, zero interest rates on.
It also, exactly, but it also means that these companies have been hollowed out in terms of their ability to sustain a period of poor trading.
Yes, precisely. So what they've all done is they've geared up to fund share buybacks. Yeah.
So that also means that the central banks have created a situation where the only thing that they cannot afford to let economic conditions properly normalize, because economies, plural, will crash.
Yeah, no, I agree.
There we are. Proportion of US bankruptcy candidates has risen inexorably.
Yeah.
So
Too much debt.
Yeah. Interest coverage is near all-time high for large US stocks. So yeah, but it's not near all-time highs for the small stocks, is it?
No.
That's the problem. Interest cover for Russell 2000 is pretty low. And the average S&P returns around recessionary bear markets. Interesting, isn't it? So this is months, presumably on the bottom line, isn't it? On the on the x-axis.
Mm.
So the average return at the trough of a recession is 0%.
Yeah.
Annual return. Where are we is the question. It says we're here at minus 15.
Well, that's the thing. The Fed, what this chart shows is the Fed tends to cut only when the economy slows, and the market, the equity market, is not expecting the economy to slow. So they've kind of got contradictory opinion. They're expecting rate cuts without a slowing economy.
And the outperformance of US equities has reached extreme levels. I mean, look at the internet bubble was an extraordinary period of outperformance, wasn't it, before the crash came? Look where we are now. I mean, common sense tells you do not want to be in this market. And this outperformance is not simply the Magnificent Seven, although obviously they're quite a significant contribution to it. So European stocks lag the US even when big tech is excluded. And equities are very expensive relative to bonds, because of course bond prices have gone up dramatically, and equities have not fallen comparatively. So the differential has got larger and larger.
Yeah. Another thing I got completely wrong this year. I just couldn't see how equities could do well against massively rising interest rates, but they have.
Historically, valuation explains 80% of returns over the next decade. And we are currently, as usual on these charts, bottom right. And what that suggests is that the return over the next decade is going to be negative if it follows the sort of norm.
Yeah, well, the bottom right is just the Magnificent Seven, Richard. The S&P 500 is not too bad, actually.
That is true, yes. But, yeah, good point, Keith.
Okay, thank you. On to commodities and energy commodities, and it was another really weak week for the oil market. So Brent fell 6.6% and is now at 75. So lower than when it started the year, down 12% year to date. Reminder, earlier in the year, all the cognoscenti were forecasting that the oil market would be in deficit to the tune of 2.2 million barrels a day in Q4. Well, here we are in Q4, and the oil market is actually oversupplied, as shown by the declining oil price. WTI down 7.1% on the week, down 12% year to date. Some numbers specific to the oil market. Well, in a break in the recent trend, there was actually a slight crude draw in the US last week, and having reached an all-time high of 13.2 million barrels a day, US oil production actually ticked down by 100,000 barrels a day last week, although up 1.1 million year to date. The Baker Hughes rig count ticked up by 5. So those falling oil prices have not led to a falling rig count, rather the opposite. As a percentage of total crude production, the US is by far the world's largest producer. Saudi Arabia, due to its cuts, has actually fallen well into third place. Moving on to natural gas, well, despite the cold snap in Europe, European natural gas prices fell by 5% last week, down 46% year to date. Good news for inflation. Same is true in the UK. UK natural gas prices down almost 7% last week, down 43% year to date. US natural gas not having a good time, down 6.5%, down 42% year to date, and that is not a nice looking trend. Coal had a big bounce, still down 62% year to date, but up 13% on the week. Let me read this out.
Interestingly, Pete, have you seen what's happened to the big coal mining company shares like Peabody?
No.
They're going stratospheric.
Really? Wow.
Yeah.
I'm very surprised. I think certainly in Europe, I think coal is rapidly being phased out. Well, let me next time I will put in charts of some coal companies and we can discuss.
Really interesting.
So Newcastle coal futures, that's the Australian benchmark, increased to $130 a tonne, the highest in over a month. The demand from China is set to rise as temperatures are falling. China's thermal coal imports for November are anticipated to reach approximately 29.2 million metric tonnes, surpassing October's 24.6. That is a big rise month on month. Out of the total, Australia is expected to deliver to China 7.2 million metric tonnes, a substantial increase from October's 4.2, marking the highest monthly total since Beijing lifted its informal ban on imports from Australia earlier this year. So basically, China is upping its imports, leading to a rising coal price. Uranium continuing to tick up 0.6% on the week and up 66.6%, the devil's number, Richard. Is that the all-time high? On to industrial metals, Richard.
Thank you, Keith. So can I just say I expect the price of uranium to continue to rise. Aluminium is bumping along its bottom, as it were. I mean, if we're going to have the sort of slowdown you would expect from what we're seeing in the commercial property and residential property markets globally, and the Chinese property market, China, you would expect the price of aluminium, steel, copper to be all in the doldrums. Then you have cobalt, which basically doesn't seem to do anything.
Yeah, it's in glut, basically.
Copper showed a few signs of life over the last few weeks. We know that there is a long-term structural deficit in copper because the electrification of the planet requires far more copper than is available or will be available.
Yeah. But
so good long-term investment.
Yeah, down 1% year to date, though.
Yeah. In my mind, a good long-term investment at the moment is copper miners.
Yep.
Carefully selected. Chinese copper imports are climbing again. It's interesting. Chromium down 7% year to date, unchanged on the week. Iron ore, actually, it's had a rapid climb in November, hasn't it? And it's up 16% year to date.
Yeah, this is all down to Chinese demand.
Yeah. I wonder where the Chinese demand is coming from, though.
Yeah. Do you remember during, was it the 5-year plan under Mao? They just had a target for producing a certain amount of steel. They didn't know what to do with it, but you know.
So it's being stockpiled.
Well, I don't know.
Maybe right. And then there'll be a huge sort of undercutting and glut problems.
Yeah.
Trade wars. There's lithium, which has dropped 81% year to date, which is substantial drop.
It's just amazing, absolutely mind blowing.
Yeah. Neodymium used in windmills, particularly. And windmills, we know, have got a bit of a problem at the moment. Nickel is continuing. Basically, it's sort of inexorable decline, down nearly 50% year on year.
Yeah, all the battery metals have had a terrible time.
Yeah, that's true. Tin,
So thank you to Rogue Trader, who last night on the Discord presented on Cornish metals, which are aiming to reopen the South Crofty tin mine in Cornwall, and had a very interesting discussion. Bottom line is they're in very early stage. So the South Crofty mine is 910 meters deep, and they need to drain the whole thing. They're taking out 25,000 cubic meters of water a day, and it's going to take them 18 months to drain the entire mine. At which point, I think you get an idea of what the shape the mine's actually in. But right now, it's far too early to invest. But anyway, if you're interested, Rogue Trader is putting a video of last night's discussion on his channel.
Interesting. Ferrovanadium, pretty much a dead dog. Zinc, down 18% on the year, but the last 6 months have been fairly unremarkable.
Yeah. But on your point, Richard, in the past week, I'd say apart from the rise in iron, everything else down a bit. So not showing any strength in the world economy.
The precious metals. So, excuse me, gold has now been above 2,000 for 10 days. And excuse me, it had an extraordinary spike. I think it was on some early hours of Monday morning where it went up to 2150.
Wow.
And then which isn't shown because it's a daily chart. It's not shown on that. And then it fell rapidly back down to where it is now. But that spike presumably was a short squeeze. So gold is trading strongly. Silver actually is not really following gold at the moment. I expect it will do, but it's fairly stable around about that $24 an ounce mark. Platinum, looks it's still stabilized, but it's not a very chart conducive to investing, is it? There's rhodium. Rhodium has been bouncing around all over the place, I noticed this week, but I think it's just very volatile. So it's 4% down on the year. Palladium, as we've discussed previously, these are very vulnerable to the catalytic converter market.
Yeah. Okay, thanks, Richard. On to rates. And it was a good week. My God. So the UK yield curve actually shifted down quite substantially and is below where it was a year ago at the long end. Now, the shape of this curve is quite odd. So you have 10-year yields well below 4% now, but then you get a 10% premium for taking more duration risk. And if we look at the US, that is not the same in the US. So again, the US yield curve has shifted down, but the shape of the yield curve looks much more normal in the US. So if we compare the two, you'll see that UK 10-year yields are very substantially below US 10-year yields, whereas 20-year yields are not. So I can't see any rational reason why there are these discrepancies. You would think either the UK yield curve at the 10-year level needs to shift up, or the US one should shift down to bring them back into line. Now, in the Eurozone, quantitative tightening continues. The ECB now owns only 50% of Eurozone GDP in the form of its bond holdings, much more than the Fed, although a lot less than the Bank of Japan. But QT may accelerate next year, which would be further monetary tightening. Now, if we look at the change in 2-year Treasury yields, generally they fall sharply after the last hike. So let's see. Crude oil tends to be highly correlated with inflation expectations as measured by the US 2-year? And will the recent fall in crude lead to falling inflation expectations? I hope so. You can see that over the last week, inflation expectations in the US have fallen across the curve. Investors think that inflation is coming under control. Okay, so this is the UK 2-year on a fairly steady downward path, but still at 4.5%. That's very high. So UK investors expect the average interest rate in the UK over the coming year, plus the term premium, to equal about 4.5%. That seems very high. It suggests they don't think UK inflation is really under control yet. 10-year, 4%. Again, down nicely, but actually still well up on the year. 30-year, 4.5%. So still also big up on the year. The US 10-year, I mean, what on earth was going on in September and October? It's basically just unwound this extraordinary spike. German 10-year, well, the market thinks that Eurozone inflation is rapidly coming under control, and that is an absolutely enormous fall. It's beginning of October, it was at 3%, it's now at 2.2%. Italian, that's enormous drop, dropping by 1% in a month and a half. Greek. So the market really thinks that Eurozone inflation is rapidly coming under control, and they are anticipating ECB rate cuts. Any view to your opinions, Richard?
I wouldn't buy gold at this point. I would hold gold. I'd like to say sell equities, but it's like reality is not with us, is it?
Yeah.
I still agree with industrial commodities being a selective buy. So that's what I would say.
Okay, and on to concluding comments. Well, inflation everywhere is continuing to fall faster than expected. The latest PMIs suggest the UK economy actually remained surprisingly resilient in November, while the EU economy is in a shallow recession. The ISM surveys for the US for November suggest that the US manufacturing sector continues to slow, but the services sector remains resilient. The US labor market is weakening. Looking forward to the coming year, I think the US economy is weakening. The lagged effect of interest rates should continue to slow economies on both sides of the Atlantic. Whether the market is correct in anticipating rate cuts for the ECB as soon as the end of the first quarter, that seems aggressive to me. Depends very much on the inflation figures. And in the US, they're expecting rate cuts as soon as April. That seems incredibly aggressive. Richard, how have you done?
So obviously the uranium gold markets have been good for me. But what is notable is that the gold and silver mining stocks aren't keeping up with gold, particularly mining stocks, aren't keeping up with the rise in the price of gold. I'm anticipating that they will, but that they're lagging. So I've done okay, but not, whilst gold is at an all-time or near an all-time high, and actually briefly pierced its all-time high, the mining stocks haven't performed so well. So I'm doing okay, but not as well as I would like. I'll do a proper analysis, probably our first one in January. Yeah. I'll do a proper analysis of what my portfolio is then.
And in the new year, we are aiming to record a lessons we have learned from 2023 podcast, and I've learned a lot.
Yeah. How about you, Keith? How's your portfolio?
Well, I'm very glad to report that I had an excellent week, although
Good, well
still
done.
shit on the year, but a hell of a lot better than it had been. As you all know, I've been expecting the economy to slow and inflation to come down sharply. The latter's happened. The economies of the US in particular has been amazingly resilient. And bond prices have sold off. So hopefully next year they continue to recover. But I'm not looking very clever, but I'm looking a lot better than I was a month and a half ago. Thank God. Now, let's talk about a company I covered in Share Talk a while ago. So that is the UK listed oil services company Petrofac. Now, its share price, sadly, is heading towards zero. Background is, when we talked about Petrofac for Share Talk, it undertakes these big engineering projects on which it has relatively low margins of 6 to 8%. But then if one of them goes wrong, it is responsible for the cost overruns. And historically, it has had cost overruns which have wiped out literally years' worth of profits. Now, we were concerned at the time that the margins were too low and it was very high risk. And what's happened over the course of last year is that those debts mean that there's danger of a restructuring and debt to equity swap, etc., etc., and the market is pessimistic about the company's prospects. And another thing we've learned is that, investing in companies with weak margins is very dangerous. If there's a downturn, they can get wiped out altogether. And so I took my profits in 2022 on Petrofac, having actually made a very good return in a couple of months as the oil market rose. And these sort of companies, highly cyclical, get out when the going's good, frankly. And this is the 2068 gilt. Now, has the cycle turned? Okay, so way back when, we're extending this back to 2010, the price was like 130. The price has collapsed to a low of 55. I, frankly, thought it had bottomed at 100 and have got absolutely stuffed. But if we assume that UK inflation starts to normalize, where does this go? It peaked at 330. I still believe that if we have a decent recession, we could get to 150. But I would hope, worst case scenario, we get back to 100. 2014, it was well above 100. So bottom line is inflation expectations in the UK as measured by the 2060 gilt are still at 3.3%. If the Bank of England succeeds in getting inflation under control, I hope those inflation expectations drop back towards 2%, and that'd be very good for me. In the Eurozone, I think you've got deflation or danger of deflation. So UK Bank of England needs to get inflation expectations under control in a way that inflation expectations in the Eurozone are rapidly coming under control. Okay, well, that is the last big Portfolio Matters for the year. Thank you all for watching. It has been an absolutely amazing year, and we will, in due course, record a podcast discussing the lessons we've learned from it. I hope you've all had a better year than me. Merry Christmas. And please, can you press like and subscribe to the channel in the meantime? It's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan, and happy Christmas to everybody.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.